Rotork surged 67% on July 16th after Swiss engineering giant ABB agreed to acquire the Bath-based flow control specialist for 506 pence per share in cash, valuing the company at £4.14 billion on a fully diluted basis. That offer represents a 73% premium to the previous day's closing price, one of the largest single-day re-ratings of a FTSE 250 industrial name in recent years. The tension is not in the premium itself, but in what it reveals. As recently as Wednesday, the market valued Rotork at 290p, below where it had traded for most of the past 5 years. The stock had rarely cleared 350p since 2021, weighed down by Middle East revenue exposure, around 10% of group sales, and general macroeconomic uncertainty. Yet ABB, with a record $30 billion order backlog and 28% year-over-year order growth, saw that same company as worth 506p. Two prices, the same business, separated by 1 day. Shore Capital, which rated Rotork at hold with a 320p target, called the 506p offer valuation as favorable, while adding that Rotork had otherwise rarely traded above 350p since 2021. That is the open question the body of this analysis must answer, not whether shareholders should tender. The board has unanimously recommended they do, but why the gap between 290p and 506p existed at all, and what the answer means for the UK industrial sector sitting around them. ABB's own second quarter results, released alongside the deal announcement, explain the price. Orders reached approximately $12 billion, a 28% increase year-on-year, pushing the backlog to a record $30 billion. Electrification orders alone surged 58%, driven by AI data center construction and industrial power infrastructure. Operational EBITDA rose 20% to $1.9 billion, with margins improving 90 basis points to 20.2%. ABB is not buying Rotork speculatively, it is buying to fill a specific gap in a pipeline already overflowing with demand. Rotork itself generated roughly $1 billion in 2025 revenue with a 24.6% adjusted operating profit margin and averaged 8% organic revenue growth per year from 2022 to 2025, serving oil and gas, power generation, water treatment, chemicals, data centers, and marine operations. ABB states the acquisition will be immediately accretive to its operational EBITDA margin, add 3% to group revenue, and add 12% to the automation division revenue. At 19.5x EBITDA, the multiple reduces to mid-teens after anticipated synergies, within ABB's stated comfort range. This reframes the deal from a rescue premium to a competitive preemption. ABB is acquiring Rotork specifically for the field device layer, the actuators and intelligent valves that automate the opening and closing of industrial infrastructure, because its own automation backlog of $2.5 billion cannot be fulfilled without them. Rotork's customers operate critical infrastructure that cannot be switched off, its switching costs are high, and its installed base service model generates recurring revenue. The 19.5x multiple is not a gift to Rotork shareholders, it is the price of locking in an asset that would otherwise compound independently. Here is the buried assumption the UK market had treated as settled, that Rotork's exposure to Middle East oil and gas infrastructure, approximately 10% of group sales per Shore Capital's analysis, was a discount factor requiring a lower valuation multiple. Uncertainty in the Strait of Hormuz, geopolitical risk, and general macroeconomic caution combined to hold the stock below 350p for 5 consecutive years. That read is not unreasonable for a trader assessing near-term earnings risk. But ABB's demand signal makes a different argument. Its electrification orders rose 58% in Q2, driven precisely by the same energy infrastructure, oil, gas, power, water, that Rotork's actuators and flow control equipment serve. The Middle East exposure that UK fund managers treated as a discount is the same end market exposure that ABB's $30 billion backlog depends on. One investor's risk discount became another buyer's strategic premium. Peel Hunt analyst Harry Phillips made the broader implication explicit. UK quoted industrials are jacks in the land of giants, global niche companies with high market shares and high barriers to entry in process and safety-critical applications. City observers noted that 154 takeover bids for UK companies worth more than £100 million have been made since the start of 2023, with a combined value of £165 billion, against just 11 IPOs worth £6 billion over the same period. ABB's bid follows recent offers for Intertek, Schroders, Spectris, Dallas, and Tate & Lyle. The pattern is not coincidence. Peel Hunt's conclusion, UK industrial assets are attractive, given this global nature coupled with the discounted valuation multiples they trade on. We believe this substantial offer for Rotork proves our point. The paradox resolves. The consensus treated geopolitical and macro headwinds as impairments to intrinsic value, but for a strategic acquirer with a complementary demand signal, those same headwinds compress the entry price without compressing the strategic asset value. The discount did not price in risk, it priced in opportunity for anyone positioned to hold through the cycle. The current stock price near 485p against the 506p cash offer leaves a roughly 4.3% ARB spread that now functions as the market's live probability-weighted estimate of deal completion. Panmure Liberum analyst Alex O'Hanlon said the likelihood of a competing offer is relatively limited and that shares will trade primarily on the probability and timing of completion. That is the first frame the holder and the ARB player need. The financing structure introduces the primary risk. ABB intends to fund the acquisition through proceeds from its planned $4.8 billion sale of its robotics division to SoftBank, announced last October. If that sale is delayed or renegotiated, ABB has committed bank facilities as a backstop, but a protracted SoftBank delay would raise questions about deal economics. The scheme of arrangement closes no earlier than H1 2027, requiring a Rotork shareholder vote and customary regulatory clearances, a timeline of roughly 6 months. The decision posture is therefore not about whether the deal is strategically sound. ABB's rationale is robust, and Rotork's board has unanimously recommended approval. The question is deal execution risk over 6 months. For a holder who bought below 290p, the 73% premium is unambiguous. The rational move is to tender. For a new entrant at 485p, the 4.3% spread against a 6-month timeline represents roughly 8% annualized, assuming the deal completes on schedule. That becomes an entry setup if ABB's SoftBank sale closes on schedule, and Rotork shareholder meeting passes without a blocking minority emerging. It becomes a trap if regulatory review in any jurisdiction, particularly the UK CMA or the EU, raises intervention concerns, or if SoftBank's financing of the robotics purchase introduces delays that push the deal timeline and widen the spread further. The metric to watch before acting is not the headline offer price, but the SoftBank robotics transaction close, which is the upstream financing event on which ABB's balance sheet certainty depends.